Hello, and welcome to episode 68 of Mo Money, the investing economic show for millennials by a millennial, where our goal is to educate, entertain, and empower a new generation of investors. I am the host and creator of this wonderful show, MC Mo. Now let's get to the money. This past week, the Economic Growth, Regulatory Relief, and Consumer Protection Act, aka the Bank Lobbyist Act, aka the Crapo Banking Bill, or to some, the Load of Crapo Banking Bill, passed the Senate this past week 67-31 and will be heading next to the House of Reps. So, what is this bill? Is it a concession to Wall Street banks? Is it a complete dismantling of the regulations installed by Dodd-Frank? Are taxpayers soon to be footing another bank bailout? Let's break it all down with this week's Mo Money topic, the effects of the Crapo bill's deregulation. First, let's break down the things that are regarded as the positive effects of the bill that helped to get bipartisan agreement. 16 of the 67 senators who passed the bill were Democrats. In short, the winners of this bill look to be small regional financial institutions like Fifth Third Bank, Zions Bank, and M&T Bank. The bill looks to decrease regulation on banks from those who have $50 billion in assets and raise it to $250 billion in assets. The decrease in regulatory costs will allow those smaller banks to create more loans and more products. These smaller financial institutions often operate in underserved areas that the larger banks do not. The fact that these smaller institutions would be exempt from capital requirement rules, meaning the amount of cash that they must hold on to in case of emergency, enables them to make more loans, which will help the economic growth of these areas. One of the Democratic co-sponsors, Heidi Heitkamp from North Dakota, said that the regulations from Dodd-Frank, which were meant to prevent too big to fail banks, created a too small to succeed environment. The bill also includes some consumer protections, including free credit freezes and a free year of fraud alerts. This is obviously meant to amend the damage done to those who were affected by the fraud of Wells Fargo and the hack of Equifax. Now on to the opponents of this bill, the progressive Democrats, and none have been more vocal than Massachusetts Senator Elizabeth Warren. The main issue opponents have with this bill is the raising of the limit from 50 to 250 billion. This will take the number of banks deemed to be systematically important financial institution, or SIFIs, from 43 down to only 12. Now, Countrywide Financial, one of the first mortgage lenders to go bust during the crisis, had only 210 billion in assets, 40 billion less than the proposed limit. These newly exempt financial institutions will be freed from some regulation. For instance, yearly stress tests, which are done to prove a financial institution is able to withstand some losses on their assets, are no longer mandatory, but now will be done occasionally. And they no longer have a need to provide living wills, which are basically blueprints of how they would unwind their institutions in case of a bankruptcy. As you can see, these Democrats have good reason to stand in opposition to this bill. The bottom line, the Congressional Budget Office said that the potential negative effects of this bill are minor. Dodd-Frank was passed in 2010. The wounds of the financial crisis were still fresh. The dust had not totally cleared. The causes not completely identified. So it stands to reason that act may have been a bit of a dramatic response and a bit overboard with its regulations. It did cause smaller institutions to be crushed under regulatory pressures, many of which were since forced to close. This one-size-fits-all policy was not a fair response to the crisis. Original writer of the act, Barney Frank, even says 50 billion was too low, but says he wouldn't vote for 250. Instead, he proposed 125 billion, half of the proposed limit. But Fed Chair Jerome Powell said the Federal Reserve would still enact meaningful stress tests and standards for those banks in the $100 to $250 billion range, as they see fit and on a case-by-case basis. This is not a complete rollback of Dodd-Frank. These rules will not cause a financial crisis. But if Congress allows these financial institutions to continue to slowly deregulate themselves, then they could have another financial crisis again on their hands. These politicians appear to be slowly forgetting the devastation of the previous financial crisis. This time around, taxpayers may not be so willing to foot the bill for Wall Street's mistakes. Thank you so much for watching another episode. You can find new and classic episodes right here on YouTube. For now, don't forget to like, comment, subscribe, share, follow me on Twitter, follow me on Instagram, like me on Facebook, check out themomoneyshow.com.
Mo Money, signing out.